you have some extra money and you're thinking about investing, or if you already invest and you want to diversify, you've come to the right place. Today, I'll walk through some passive investment options that can help you grow your wealth faster than a savings account. For each option, I'll talk about how it works, the potential risks and returns, as well as how you can get started. If you find this video helpful, don't forget to toss it a like and subscribe to my channel for more videos like this one. The first option we have are CDs. This is a type of savings account offered by banks where when you put money into a CD, you agree to keep it in the account for a set period of time, usually between a few months to a few years. In exchange for this commitment, the bank pays you a higher interest rate than you would get with a regular savings account. The main risk is that if you need to withdraw your funds early, you gotta pay a penalty. And since your money's locked away, you might miss out on higher potential returns. CDs are considered to be a low-risk investment because your money's typically insured by the FDIC and you'll know what return you'll receive. The returns are higher than a regular savings account, but lower than some of the other options we'll go through next. If you're interested in investing in CDs, you can start by shopping around to compare rates and terms offered by different banks. Once you've decided on the term length and amount of money to invest, open an account with a bank that offers the best rate for your desired term length. Another investment option is bonds, where you effectively loan money to a company or government for a period of time in exchange for regular interest payments and your initial loan back. The main risk of a bond investment is if the borrower you loan money to can't pay you back, you lose your investment since these loans aren't insured like CDs. Because of this, safer borrowers like the US government typically pay lower rates since they're less likely to go bankrupt, while riskier borrowers typically pay higher rates to compensate for the additional risk to you as a lender. Although more risky than investing in CDs, bonds are still relatively low risk because you have a predictable stream of income and you know what returns to expect. But remember, the risk level does ultimately depend on the borrower. If you're interested in investing in bonds, it's important that you educate yourself before putting down any money. Build an understanding of the types of bonds out there as well as bond-related concepts such as ratings, yields, and the different characteristics bonds can come with. Once you're ready to invest, you can purchase bonds through a brokerage like Fidelity, TD Ameritrade, or E-Trade. You can also invest in an investment fund like an ETF or a REIT. ETFs represent a collection of stocks, while REITs focus on real estate investments. Investing in an investment fund can give you exposure to multiple assets, reducing your risk and potentially increasing your returns in exchange for a small fee to whoever manages the fund. The main risk of an investment fund is that the value of the fund is based on economic factors out of your control. The decisions made by the manager of the fund also directly impact your investment, so it's important that you trust whoever's managing the fund you invest in. Despite these risks, investing in funds typically is less risky than picking individual stocks since funds are usually well diversified. Investment funds usually offer better returns than CDs and bonds, albeit with a bit more risk. Getting started with investing in funds is similar to bonds. You want to make sure you understand the different funds out there and what they invest in. Once you're ready to invest, you can invest in funds through a brokerage account or a retirement account. You can also invest in stocks. Stocks represent ownership in a company and are bought and sold from stock exchanges. When you purchase a stock, you become a shareholder and have a claim on the company's assets and earnings. The value of a single stock can be impacted by many factors like company performance, changes in the economy, industry trends, and other news. Investing in stocks can be a high-risk investment, but if the company whose stock you own does well, you'll get to reap the benefits since you own a piece of that company. To get started with investing in stocks, research different types of companies and industry trends to decide what you want to invest in. When you're ready to buy, you can purchase individual stocks through a brokerage account or a retirement account. Next, there's cryptocurrency, which is a digital asset designed to work as a medium of exchange. Bitcoin is the most well-known cryptocurrency, but there's now thousands of different coins available. Crypto is considered an extremely high-risk investment with volatile prices, limited regulation, and high accounts of fraud and hacking. That being said, returns from cryptocurrency can be extremely high and fast since it's a relatively new asset class that's developing rapidly. When getting started, do the appropriate research and make responsible investment decisions. You can buy crypto on an exchange like Coinbase or Binance. When choosing an exchange, make sure it's reputable and secure and understand terms and fees associated with it before you deposit any money. So as you've seen, there's many different investment options out there, each with their own level of risk and returns. What's important is that you make an informed decision on which option to take based on your personal financial goals and your risk tolerance. Thanks so much for watching. If you enjoyed this video, don't forget to smash that like button and smash that subscribe button to see more videos like this one.